So, have you ever seen a company drop what looks like a fantastic earnings report and the stock just does nothing? That's exactly what happened with Old National Bancorp. They just posted what looks like a blockbuster quarter, record profits, really strong growth, the whole nine yards. But Wall Street? Pretty much a yawn. So today, we're going to dig into ONB's Q4 earnings and try to figure out what's really going on here. What's the hidden story that the market might be missing?
All right, so here's our game plan. First up, we'll hit the Q4 print, the big numbers and why the market was so quiet. Then we'll dive into management's playbook for the year ahead. After that, we'll check in on the analyst view, see what the pros think, and finally, we'll wrap it up with our own take in the next call.
All right, let's get right into it. The Q4 print. These are the numbers that kicked everything off. Okay, so just looking at the numbers, this quarter was an absolute home run. I mean, look at this. Adjusted EPS came in at 62 cents, which was a solid beat. Loan growth, super healthy, at 6.4%. But the number that really jumps off the page for me is that adjusted efficiency ratio. It hit a record low of 46%. And for a bank, that ratio tells you how lean and mean their operation is. Lower is always better, so hitting a record low, that's just fantastic.
And right here, this is where things get weird. This is the big puzzle. You've got the management team on their earnings call, and they're practically doing a victory lap, calling 2025 a year of record performance. Super bullish, right? But then you look at the stock. What did the market do? Basically nothing. A collective shrug. The stock barely moved. So you have this huge disconnect between what the company is saying and how the market is reacting. And that's exactly what we're going to figure out.
Let's just zero in on this number for a sec, 46%. You know, in the banking world, this is a huge deal. It's basically a report card on how well you're running the place. So to hit a record low like this, it tells you that all those cost savings they talked about from the Bremer bank integration, they're not just some PowerPoint fantasy. Nope, they are real and they are hitting the bottom line right now.
And hey, this isn't just a story about cutting costs. That 6.4% loan growth, that shows the engine is running hot. Their main business is firing on all cylinders. This is so important because it means they aren't just shrinking their way to better profits. They're actually out there growing, winning business, and taking market share. That's what you want to see for future growth.
And let's not forget about their capital position. That CET1 ratio is sitting above 11%, which, trust me, is incredibly strong. Think of it as their financial shock absorber. It's how they weather tough times. Being this well capitalized means they have a fortress balance sheet, which gives them a ton of flexibility to either grow the business or, return more cash to shareholders. Okay, so the numbers look great, no doubt about it. But what's the story behind the numbers? What's management's plan to keep this going? Let's get into their playbook for 2026. In this quote from the CEO, Jim Ryan, really says it all, doesn't it? The best investment we can make is in ourselves. He's basically telling the market, look, we're not going out on some crazy M&A shopping spree. The game plan is simple and it's clear. Focus on what we do best, grow organically, and give the profits back to shareholders. It's all about discipline. All right? Now, every company forecast is built on a set of assumptions, right? And these are the key ones for O&B. They're expecting a couple of rate cuts from the Fed next year. But check this out. This deposit beta of 40% is a really big deal. Let me translate that. It means they think that when the Fed cuts rates, they'll be able to hold on to a lot of that benefit. For every 1% the Fed cuts, they only expect to lower the rates they pay on deposits by 0.4%. That difference, that goes straight to their profit margin. It's a huge potential lever for them. So what's the roadmap from here? Management basically gave us a 3-point plan for what to watch in 2026. First, keep that loan growth humming along in that 4 to 6% range. Second, and this is key, use a built-in tailwind to boost their net interest income. And third, they're signaling they're going to get more active with share buybacks. So growth, income, and returning cash to shareholders. Got it. So what the heck are these repricing tailwinds they're talking about? It sounds complex, but the idea is actually pretty simple. Imagine you have a bunch of old investments, maybe some bonds, that are paying you a really low interest rate, like 2%. Well, as those old investments mature, you can now take that cash and reinvest it at today's much higher rates, say 5%. That's free money, essentially. It's a built-in, almost automatic profit booster that's already locked in for the year ahead. It's a really powerful concept. Okay, so we've got the numbers, they're solid, we've got management's story, it's compelling. So what gives with a flat stock price? Let's see how the Wall Street analysts, the pros who do this for a living, reacted after they had some time to really dig in. And this chart, This chart really tells the story. It puts the whole situation into perspective. You can see right here that over the last year, ONB has been a serious laggard. The General Regional Bank Index, the KRE, is up over 12%. ONB, just 5%. That big gap, that underperformance, is exactly why this story is so interesting. It screams potential catch-up trade.
So while the market was sleeping on this, the sell-side analysts were not. The verdict from them was pretty clear, and it was decisively positive. UC Stevens and RBC raising their price targets, but the big one is TD Cowen, coming out with an outright upgrade to buy. This is pretty telling. It suggests that the people whose entire job is to analyze these banks, well, they looked past the flat stock price for one day and basically said, yeah, we believe management's story.
So let's recap. We have a clear disconnect, right? We've got fantastic numbers, a super confident management team, and Wall Street analysts giving it the thumbs up. And yet, the stock has been an underperformer. So what happens now? That brings us to our final take, the next call. We're going to put all the pieces together and give you our view on what's next for ONB.
All right, after digging through all of this, we're putting an outperform rating on Old National Bancorp. And here's the simple thesis behind that call. It really comes down to a few key points. First, that NII growth from the repricing tailwinds we talked about, it's not wishful thinking. It's a credible, visible path to higher earnings. Second, they're about to get the last big chunk of cost savings from that Bremer integration, which means that already record low efficiency ratio could get even better. Third, they told us they're going to speed up the buyback. That's a direct catalyst to support the stock. So you take all of that, you look at how much it's lagged its peers, and you see a clear valuation gap. We think that gap is going to start closing as all these things come into focus in the first half of next year.
And just as a reminder, this is not financial advice.